Hey everyone, welcome back to the channel. If you're new here, make sure you hit that subscribe button and enable notifications because we're constantly breaking down the most interesting and undervalued opportunities in the stock market that the average investor completely misses. Today, we're diving deep into what I genuinely believe is one of the most compelling opportunities hiding in plain sight. 5 high-potential penny stocks trading under $5 that represent some of the best risk-reward asymmetry available right now. Before we dive in, I need to emphasize that this is purely educational content meant to inform your own research and thinking. This is absolutely not financial advice. Always conduct thorough due diligence and consult with a qualified financial advisor before making any investment decisions. Penny stocks are inherently volatile and speculative, so only allocate capital you can genuinely afford to lose. That said, if you stick with me, I'm going to break down exactly why these specific companies are trading under $5, what makes each one interesting from a fundamentals perspective, and how disciplined investors can think about approaching this space. The beauty of the sub-$5 space is that you have access to stocks that have genuinely massive upside potential, but are completely overlooked by mainstream Wall Street research, by institutional investors, and by the retail investors who are all chasing mega-cap technology stocks. When you can find a company trading under $5 with real assets, real revenue, or real technological positioning, you're often looking at an opportunity that's being left for dead despite having genuine fundamental merit. These aren't companies that will go from $3 to $4. The winner stories are the ones that go from $3 to $20 or $30. That's where the outsized returns come from in this space, but obviously the flip side of that is that penny stocks carry substantial risk. They're thinly traded, they have wide bid-ask spreads, they're susceptible to manipulation and pump-and-dump schemes. Most penny stock traders lose money, that's just the reality. So position sizing, risk management, and emotional discipline are absolutely critical. Now let me walk you through 5 specific opportunities currently trading under $5, each with distinct characteristics and investment theses. The first opportunity is a Canadian cannabis company operating one of the most important segments of the global medical cannabis market. This company has demonstrated consistent revenue growth with global medical cannabis net revenue expanding year over year and international medical cannabis revenues hitting record levels. They've expanded their footprint into multiple countries and established leadership positions across diverse markets. The most interesting part is the macro tailwind. Cannabis regulatory environment is evolving rapidly around the world, and particularly in the United States, where federal reclassification could be imminent. The company maintains a strong balance sheet with solid cash positions, allowing for continued international expansion. The stock has experienced significant volatility, but has shown strong technical signals with upward momentum in recent periods. Cannabis legalization represents a secular trend, and this company is positioned to benefit substantially if federal policy shifts in the United States toward legalization or reclassification. The key risk is execution. Can the company continue expanding internationally and maintaining profitability while navigating regulatory changes? The second opportunity is a Spanish telecommunications giant trading at a significant valuation discount, despite being one of Europe's largest incumbent telecom operators. This company operates across multiple markets, including Spain, the UK, Germany, Brazil, and Latin American countries. They're actively investing in fiber infrastructure expansion with targets of reaching millions of premises across Europe. The company is executing a 5G rollout and focusing on expanding high-value business services contracts. They're also executing strategic asset sales and simplifying their corporate structure, which could unlock shareholder value. The valuation is incredibly compressed, with the company trading at a significant discount to book value and with an enterprise value to EBITDA multiple that appears extremely reasonable. The company generates substantial free cash flow that supports debt service and potential shareholder distributions. The primary risk is regulatory headwinds in key markets and competition from emerging carriers. But from a value perspective, if the company successfully executes its digital transformation strategy and improves operational efficiency, re-rating upside could be significant. The third opportunity is a Colombian financial services holding company providing banking, pension management, and investment services across Colombia and Central America. The company operates multiple banking subsidiaries and has demonstrated strong profitability metrics with net income generation and positive return on equity. The stock has delivered exceptional returns recently, with more than 100% gains year over year. The company pays a dividend yield around 4.7%, which provides income while you wait for capital appreciation. The valuation remains reasonable despite recent gains, trading at a single-digit price-to-earnings multiple. The financial services sector in Latin America remains underpenetrated with significant growth potential as economies expand and credit demand increases. The company benefits from secular trends of rising credit demand, digital banking adoption, and expanding middle classes. The risk is economic recession in Latin America, currency depreciation impacting foreign earnings, or credit deterioration if economic growth stalls. But from a risk-reward perspective, a profitable financial services company trading at reasonable valuation in a growing market represents compelling value. The fourth opportunity is a South Korean display technology company engaged in manufacturing and selling thin-film transistor LCD and OLED display panels. This company supplies panels for televisions, notebook computers, monitors, tablets, smartphones, and automotive displays. The company is experiencing a genuine profit turnaround after a challenging period, with recent quarters showing return to profitability. They're investing heavily in OLED technology, which represents higher margin products with stronger secular demand. The automotive display market represents a massive growth opportunity as vehicles become more digital and require sophisticated display solutions. The company has recently announced a value-up plan with financial turnaround metrics. The display industry is capital-intensive and cyclical, but the company's positioning in OLED and automotive displays positions them well for the next cycle. The valuation is attractive for an emerging profitable company in a critical technology sector. The risk is cyclicality in the display industry, capital intensity of operations, and competition from other display manufacturers. But if the company successfully executes profitability improvements and OLED expansion, significant upside is achievable. The fifth opportunity is a Canadian software and services company that transformed from a smartphone manufacturer into an intelligent security and Internet of Things software provider. The company operates three business segments, including secure communications, serving government and enterprise customers, QNX, which provides embedded operating systems for automotive and industrial applications, and licensing of intellectual property. QNX is the most interesting. It's embedded in hundreds of millions of vehicles globally and provides software-defined vehicle solutions. The automotive industry is undergoing massive digital transformation, and software-defined vehicles represent a structural growth opportunity. The company reported strong recent earnings with revenue and earnings expansion. Analysts are becoming increasingly bullish, with analyst price targets suggesting substantial upside. The company operates a lean business model with software and services economics that are much more attractive than hardware manufacturing. The primary risk is execution of QNX growth strategy, execution of the cybersecurity business, and potential disruption in automotive software. But the company's positioning in the automotive software and cybersecurity megatrends gives it meaningful growth potential. Now let me establish how to think about evaluating and trading these opportunities responsibly. First, position sizing is absolutely non-negotiable. You should never allocate more than 1 to 2% of your total portfolio to any single penny stock. The entire sub-$5 allocation should not exceed 5 to 10% of your overall portfolio. This mathematical discipline ensures that even if you're wrong on multiple picks, you don't blow up your portfolio. Second, focus on companies with real revenue, real profitability, or a clear path to profitability, and meaningful competitive advantages or market positioning. Avoid pure speculation or companies with no tangible business fundamentals. Third, always use limit orders. Never use market orders on these stocks. The bid-ask spreads are too wide and you'll get executed at terrible prices. Fourth, have predetermined exit rules before you buy. Know exactly where you'll sell if things go wrong and where you'll take profits if things go right. Emotions destroy penny stock traders. Fifth, do your homework. Read earnings reports, understand the business model, know the key competitive dynamics, and understand what catalysts might drive stock appreciation. Let me discuss liquidity considerations, which are critical for these stocks. Many of these names trade with limited daily volume. If you buy a position and it moves against you, getting out might be challenging. This is why position sizing is so critical and why you need realistic timeframes. Some traders work with 12 to 24-month investment horizons before they'd consider a thesis failed. The flip side is that when things go right and the stock starts appreciating, the liquidity can work in your favor if you're patient and methodical with your exit. From a technical perspective, all 5 of these stocks have shown interesting price action, support and resistance levels, and volume characteristics. The specific technical setups vary by company, but the overarching theme is that valuations have been compressed to levels that seem potentially disproportionate to underlying business fundamentals. Though distinguishing between genuine opportunity and a value trap requires careful analysis, macro considerations support multiple investment theses here. Cannabis legalization globally continues advancing with immense potential in the United States. Telecommunications infrastructure spending is a priority in developed economies with 5G and fiber deployment driving capex cycles. Financial services in emerging markets remain a structural growth story with credit expansion. Display technology innovation, including OLED and automotive displays, represent a secular growth opportunity. Software-defined vehicles and automotive embedded systems represent a multi-decade growth trend. These macro tailwinds suggest that well-positioned companies could experience meaningful growth if execution is successful. Here's what I want to emphasize before we wrap up. The under $5 space contains both genuine opportunities and significant risks. The 5 companies discussed today are all trading at valuations that suggest the market is pricing in limited growth or is simply overlooking their potential. Whether that represents actual opportunity or justified skepticism is the central question each investor must answer through thorough research. Cannabis regulatory evolution, telecom digital transformation, Latin American financial services growth, display technology innovation, and automotive software platforms are all credible growth narratives. The question is execution. Will management teams actually capitalize on these opportunities? Will competitive dynamics remain favorable? Will macroeconomic conditions support growth? Those are the questions that separate winners from losers in this space. If you're going to participate in sub-$5 stocks, educate yourself thoroughly on these specific companies, position size appropriately, use disciplined trading with predetermined entries and exits, and accept the volatility that comes with microcap securities. Penny stock investing is speculative by definition. It requires research, skill, patience, emotional control, and luck. But for traders who can handle it and who do their homework, the opportunities are genuine and the potential returns could be significant. I really appreciate you taking the time to work through this analysis with me. If you found this helpful and you want to see more content breaking down undervalued opportunities in overlooked sectors, please like this video and subscribe to the channel. Drop a comment below and let me know, which of these 5 stocks do you find most compelling? Do you see hidden value in any of them? Are you concerned about risks specific to certain companies or sectors? Your thoughts help me understand what content resonates with you, and remember, this is educational content meant to inform your own research, not a recommendation to buy or sell any security. Always conduct your own thorough due diligence and consult with a qualified financial professional before deploying capital. Thanks so much for watching, and I'll see you in the next one.